If you are a new business that is starting to make money, then you need to take advantage of all the legal ways to keep more of that money. Making sure the type of entity that you form is an important step that could save you a lot of money in the future. Hopefully one of the first things that comes to mind when you own or are looking to start a small business is, how am I going to pay myself as a business owner? In this video, I'm going to go over the different ways that you can be paid when you're in business for yourself. I'm going to talk about the benefits of utilizing an LLC for tax reasons, and how you can pay yourself using a classification known as a Subchapter S corporation. When you form a sole member LLC, meaning there's only one person involved in the business, or a multiple member LLC, this is considered a disregarded entity. A disregarded entity is nothing more than telling your state, or basically the public, that you run a business under more than just your social security number. This is primarily done as a way to minimize your liability in the event that you're sued. If you want to watch another video about entity formation and different types, check this one out here. When you file your articles of incorporation, which is the legal document that brings your business to life, you're also going to apply for an EIN, or an employer identification number. This is the number that's on file with the IRS and ties your business name, address, and other information that gives the IRS the ability to tax you. Think of the EIN as a social security number for your business. Just like the way you pay taxes to the government personally, now your business must also pay taxes. You're going to take that number to a bank, and you're going to establish an account, either checking or savings, that all the money that your business makes flows through that account. The government is going to want to see at the end of the year how much money your business made. Now that your business has made money, there are two ways that that money can make it from your business account and flow to you or to your personal account. There's specific advantages and disadvantages of both. The first way to pay yourself is what is called a distribution. A distribution is simply money that is taken from your business checking account and put in your personal checking account. This can be in a means of a check or an automatic transfer if your bank is set up that way. On the surface, it is very simple, but let's take a look at how the IRS sees this as a form of payment. As an LLC, you can pay yourself or you can pay your employees. When you pay your employees, you receive a deduction. That means that you will not pay income taxes on those wages because they are an expense to the business. When you pay yourself by either writing a check or transferring money, these are not deductible as an expense and will not lower your taxable liability on your business income. Essentially, you'll be paying taxes on the money at the business level, which is a higher tax rate in comparison. To avoid this situation, you would do what is called a S corporation election. This is filed with the IRS at the same time your paperwork to form your entity is. This is a separate form that is filed with the IRS when you're applying for your EIN. This means that your business will now be subject to the March 15th tax line, so make sure you're talking to your accountant beforehand to be prepared for that. When you convert to a Subchapter S, this is telling the IRS that this will be passing the income or loss to yourself to be taxed at the personal level. Now, there are rules that come with this tax advantage. The biggest thing you want to factor in with the S corporation is you want to give yourself or any other members of the LLC what is considered reasonable compensation. What reasonable compensation means is what you would pay someone else to do your job. In our situation as a trucking company, I have to pay my brother a minimum of what another truck driver would be paid. For myself, since this is just a part-time job for me, I would pay myself what I would pay someone else to handle the bookwork. Thinking this way, you can always pay yourself more, but you should never pay yourself less than that minimum amount. The reason that this rule exists is that when you pay yourself wages, you're required to pay employment taxes on those wages. Employment taxes are things like Social Security, Medicare, and unemployment insurance. As an employer, you must pay those taxes also. The reasonable compensation rule makes sure that the government gets their fair share of their money. Now, when you pay yourself through distributions, you're not required to pay those taxes, and neither is the business. When considering reasonable compensation, you also need to look at what the net income of your business is going to be. Your net income takes into account all of your expenses in your business, and what's left over is essentially what you could pay yourself. Once you have those two numbers, your gross income and your net income, then you can calculate what's a reasonable compensation for yourself. Make sure you're meeting with your accountant, because they'll be able to tell you what in the IRS's eyes is reasonable compensation. Now, about those distributions. Those distributions would not pay the employer portion of those taxes. The total employer tax rate is 15.3% that's split between the employer and the employee. When you take a distribution, you're only paying the Social Security, Medicare, state, and local income taxes on your personal tax return. So once you establish your reasonable compensation, use a third-party provider such as Quickbooks or ADP or something like that to administer those checks to yourself. 1, they'll be able to calculate exactly how much withholding you have to have, and 2, it'll provide a track record or a paper trail, if you will, in case you're ever audited by the government. Beyond that reasonable compensation level, you are free to take distributions within your business as long as your cash flow supports it. Because those distributions will be considered cash flow into your business, there's no deduction, and you'll have to pay taxes on it at the end of the year. By taking advantage of this type of entity, you could effectively save yourself a lot of money in taxes. If you're still not sure about the benefit, reach out to an accountant and they can explain it more. Thanks so much for taking the time to watch this video. I wish you continued success in your business, and until next time, have a great day.